Welcome to Drill on Earnings. We have quarterly results out from Oracle. This is the business story behind one stock on the move. I'm Cory Johnson, Chief Market Strategist for Epistrophy Capital Research. Full disclosure, Oracle is a stock that I own, and although it's down in after-hours trading, I want to take try to remove my personal feelings from these results. They look pretty good to me. Wall Street just likes a beat or a miss, and this was just below Wall Street's estimates. Wall Street was at $4.12 billion. This was $4.1 billion. Wall Street was at adjusted earnings per share of $1.48. It was $1.47 of adjusted earnings per share, but they were up. Earnings were up, revenues were up. The actual numbers, let's look at it. So we saw a 9% increase in revenues, an even better quarter than last quarter when it was 7%. Earnings per share also up 10% in the quarter. 24% if you look at just GAAP numbers. So big improvement in earnings and a nice improvement on the top line here. Let's go a little bit deeper. So, and very importantly, one of the billings numbers that they put up, their remaining performance obligations. Those are the contracts that they have signed, but they haven't accepted all the revenues for. It's on top of deferred revenues. Those numbers were through the roof. 49% increase in RPOs, remaining performance obligations. So cloud revenues up 24%. Cloud infrastructure up 52%. A lot of the business was doing very well. I think the thing that in my model that surprised me was that the infrastructure as a service business, really their data center business, their business that competes with Microsoft Azure and AWS and Google Cloud, that did better than my estimates. The software business did a little bit worse, but let's dig into that a little bit deeper. So operating margins of 30%, really strong profitability from this company. It's one of the great models of all time, and it's diversified between lots of different products, cloud services, license support, cloud licenses, hardware, services. But really the four big businesses are really being driven by the cloud. And indeed, while the license support business has been giving them a nice base and has been very flat for them, at the top of their stack, if you will, their cloud services business growing fantastically. And their cloud infrastructure business, which is very tied in with that, also growing really strong. And that's where you see most of the growth from this company. And as I mentioned, RPO is surging up 48%. That's future orders. That's a revenue that's going to show up in the next year or so. That is really good news for Oracle going forward because it is so dramatically outpacing that 9% revenue growth, 48% RPO growth on the quarter of on the back of more than 50% last quarter. My goodness. How did the stock react? Well, the stock was down 7% in after-hours trading. I think people were really starting to think that this is a pure AI beat and miss story. That is not a game this company plays. They put up the numbers they put up, and you can decide for yourself if you think they're pretty good. Like I mentioned, I'm completely biased because I own the stocks. We'll take that out of it. In the last year, the stock's up 67%, so I'm happy. But when you look at what's driving the growth here, as I mentioned, the big license support business, let's take out the four biggest businesses. So license support, flat. App and cloud services, single digits. But you saw 17% in the OCI, the Oracle Cloud Infrastructure business. That's essentially the business that competes with AWS and the like. And their cloud services business. So that's offering Oracle databases and so on in the cloud. They're a software as a service business. And most of the growth in that business is offering their software as a service on the Oracle Cloud. This is before they signed the big deals with Microsoft and Google and Amazon that they've signed in the last year. So those things are going to come in as a kicker, or so said the company in the conference call. But already the cloud services business growing faster than any other major business at Oracle, followed only by the OCI cloud business itself. Really fantastic here. And one of the keys to this, and one of the ways they've been able to build this so cheaply, is that their data centers are coming into the market after the market's sort of been established by these other big players. So they're building somewhat smaller data centers. They're also doing it in a cost-efficient way, not just because they're smaller to start and let the business come in, but every one of them has a very similar construction. The data racks are the same size. The equipment in them is the same size. At every one of their data centers at any place in the world, you can get the same kinds of services and running on NVIDIA chips, H100s, H200s, and tens of thousands of Blackwells on the way. So whether it's a small data center, 50 kilowatts, or even giant ones, 1.6 gigawatts, they've all got the same kind of construction. Founder and CTO Larry Ellison explained that in some interesting detail on the conference call. Check it out.
So our basic small data centers, 50 kilowatts, and our data centers, the largest data center we're currently building now is 1.6 gigawatts. So that's quite a range. 50 megawatts to 1.6 gigawatts. And when we build them and we put them in inventory, the racks are pretty much the same. So it's very easy for us to manufacture these. It's lower cost to manufacture these. The inventory is less because they're all kind of the same. Furthermore, every cloud region has all of our services. They have all the same services, so it's easy for customers. We don't have to provision like our competitors do. Our competitors have some of their services in some regions and some of their services in other regions. We have all of our services in all of our regions, even though we are both smaller in terms of our smallest region and larger in terms of our largest region than our competitors. When all of our racks are the same and all of our services are the same, they become very easy, or I should say easier to automate. They're all identical. We have one suite of automation tools that works in all 100 of our current regions. And it makes it possible, because of the high degree of automation, to run not dozens of regions, but hundreds, or even theoretically thousands of regions, as individual customers are dedicating their own region. Individual customers are buying complete Oracle regions and installing them. What seems like it would be on-premise, though it is a full Oracle cloud region, just happens to be in a dedicated data center to that customer. We are selling a lot of those as well. So it allows us to address a market that our competitors can't reach. So standardization, automation, and from the smallest to the largest data centers give us a huge advantage in competing in this marketplace.
So what's it all mean? What's your big drill down earnings takeaway on Q2 earnings from Oracle? Well, revenue's up 9% on a year-over-year basis. It's even better than last quarter. Stock market didn't like it. It missed the stock market's numbers, so the stock is down. I'm a holder of the stock, so I'm completely biased. I want to say that again. But I think the most shocking thing here was that they have gone into this business competing with Amazon Web Services, Google Cloud, Microsoft Azure, and they're building a shockingly large OCI, Oracle Cloud Infrastructure business, now growing at 17% year over year, over $6 billion in quarterly revenues. This company is a force to be reckoned with in the cloud. All right, I'm Cory Johnson. Thanks for checking out Drill Down Earnings. Subscribe. We want to see you again.